Eric Mwatha with Mwatha.com. In this Rethink video, we are going to be taking a look at the RSI and go straight to the understanding here that even though the RSI has generally been described as a measure for how oversold or overbought a stock is, I think that definition is wrong. And I show you in these two examples that the RSI is actually a measure of sentiment, and you can also look at it as a measure of demand. We've been talking a lot about when the RSI moves above 69.10, and what we have here is a 3-year monthly chart, and once a stock moves above that, as proof that the RSI is actually a measure of demand, a measure of sentiment. In this case, once a stock moves and shows its power by moving above the threshold of 69.1, the stock is telling you that it is in demand and it has bullish DNA or bullish sentiment, which technically should be taking the stock higher. We can see in this example, yes, it is an ideal example, but you see the proof, undeniable proof, that after the stock moved above 69.10, which was during this breakout here at about $45, late 2013, the stock has held above that threshold since then, and we are looking at a price gains going all the way to 130 here in the last month. So that is proof positive that yes, the RSI should actually be looked upon as a measure of sentiment and a measure of demand for a stock or a security or any trading instrument, as opposed to a level of how overbought or oversold a stock is. We also see here a very nice example of what I call 1 month of rest minimum requirement whenever you are looking at a monthly view. So we had 1 month of rest here, so the buy point is here. In this example, we have another 1 month of rest minimum requirement. If you're trying to time a stock that you've missed, wait for at least a 1 month of rest. If you want to buy the next breakout, you can see there that was your next entry level. We see another 1 month of rest, which gave investors another opportunity for a breakout if you're trying to time the entry. And on the stock, when it's on an upswing, we see another ideal situation. So this one is actually very interesting to me because it has only managed to take a break for 1 month before continuing on with this nice hyperbolic move. So again, here main analysis here is that the RSI is a measure of demand for security and also a measure of sentiment. One more. And we can take a look here at another ideal situation where we see that the stock breaks out to all-time highs, or the ETF, above 69.10, and since then it has held above that level. The breakout that gave this move here was at a price, or let's call it here in about $27, $28, somewhere in that price range, and since then we can see the instrument is trading as high as 140 here. So obviously the RSI is a measure of demand, and obviously the RSI is a measure of sentiment. And here, once the stock did meet the minimum requirements, it was proving that it was in demand, and that demand has not faded since then. And so the theory is, whenever you see a stock do this on the monthly, you really have no reason to sell until it moves back below 69.10. In this example, we see multiple months of rest before the next breakout. As we can see here, nice entry. Again, it gives you an opportunity after 1 month of rest here. Now, these are ideal situations. So, but the point here is to show you that you can time entry into stocks that have already had a nice gain and you do this by using the previous monthly closing high as your next buy point. Not all breakouts are going to work. In this instance, they did work, but I am showing you this from the standpoint of understanding that this is what you're looking for. It's not going to play out like this every time, I guarantee you, and I'm pretty sure you know that. We are using this as a visual illustration for what we are looking for, and all these points that I'm drawing here are multiple breakout entry levels where the stock gave you an opportunity to play the next potential upside move. Again, not all the breakouts are gonna work, but the key is to illustrate that you can use that monthly rest period for your next buy point. And sometime it's gonna work, sometime it's not gonna work, but you can always know that that's what you're looking for. The theory is that you are trying to buy a stock after it has gone up. So the stock comes here, takes a break. Oh, let's just do it this way. Takes a break there, and then you have at least 1 month of rest, one down month, like that, and then you're supposed to buy the next breakout attempt, not knowing that it's gonna work or not. So you buy the next breakout attempt after that 1 month of rest here, after this high. So you buy that breakout high, that's your entry, and once you're in the stock, now you can see whether it's gonna do well or not. But if you want to play momentum, there's no way to escape this. You have to wait for a break, a pause in the action, and then you can go and find an entry into a stock, an instrument, a commodity, or a general market. So that's the theory. And again, don't forget the RSI, a measure of demand, a measure of sentiment. Eric Moore, good luck, peace, and blessings. Woo!